Christof, just straight up your reaction to OPEC Plus once again taking the decision. And this time, I suppose, for the first time in 3 months, maybe it's not a surprise, but nonetheless, kind of still surprising that OPEC Plus is making these decisions.
Yeah, third time lucky. Good morning. A few points maybe on that one. First one, as you said, not really a surprise. So it's in the headlines, but these things, of course, operate with a lag. So now it's the third time we will see in the balances and in the storage figures this month for the first time the impact of the previous increases, I should say by now. And so that might deteriorate the balances and may therefore have a more than temporary price effect different from the previous ones. Second one, also as the dust settles and this becomes a regular occurrence, becomes more and more clear what the motive is. Remember last time we speculated around, is it punishment of those not compliant? Is it helping Trump for some, as of yet, undefined excursions into the Middle East or may keep him happy? No, it seems to be clear. It is preparation of the ground for the fact that demand will fall short of expectations. There's too much spare capacity in the system, and it is becoming a game about market share now. And that is going to be very interesting then if the global economy falters to the extent that we really see a drastic shortfall of demand that could well bring forward a situation similar to peak oil in which defending market share only is possible at the expense of somebody else because the market is shrinking. And that means into a maybe slow motion, but still in effect a price war with prices coming severely under pressure over the medium and long term. But that seems to be the game. Kazakhstan before pretty open that they wouldn't comply. Russia in the decision apparently, or they let it be known that they would have preferred tighter policies and higher prices surprise. But Saudi Arabia firmly on course now, I think, since April, to put themselves into a better position for the situation in which we have balances going up and suppliers coming under pressure.
Christof, just taking that point, the sort of Liberation Day tariffs, and of course, everything sits within that context as well. This month of May that has just passed was the second month of the sort of Liberation Day strategy, which started and then was suspended. So we're still in the suspended window of the reciprocal tariffs, but still they generate a lot of headline noise, as they did last week again with the apparent breakdown in Chinese-US sort of détente around their suspended tariffs. How big a factor is that, do you think? Are these, you mentioned that OPEC Plus strategy is now clear, it's a market share one. Is that just some coincidental parallel corridor to the tariff trade war that's going on in the wider world? Or how are those two things interconnected as you look back and that the last month has given us some guidance on? They're connected or they're just separate and coincidental?
They are connected and they are connected in two major ways. Whether that's a coincidence or not, I don't know. The big broad way in which they're obviously connected is the impact of Trump's policies on global economic growth and therefore on oil demand. And that story is quite straightforward. I mean, what we are seeing now is this incredible back and forth in tariff negotiations. And I tell you, of all the news coming out every day, about what happens in Washington, the little piece which worried me the most came recently when it became clear after some journalist asked him that Trump apparently had not been told by his advisors about the phrase of the taco trade. Now, Trump always chickens out so that, he makes a big announcement, stock markets plunge. As an investor, you buy because he chickens out and takes it back. He was going mad at the question, of course, but it became clear credibly apparently that he wasn't being told about that. And he thought it is a good negotiation tactic, but it wreaks havoc with planning and with people's reactions. And then something we can talk about later. This is now only the first part of the big drama. The second part is going to be his tax passage, his tax package. So first link to OPEC policy is that it becomes clear that there's now an increased risk of global growth turning sour. And therefore, having decided that you go for market share, you rush to the exit. You want to be the first one who is at full capacity when demand goes down, and you want to do this now as long as the going is still good. So if you give up basically on the expectations of being able to hold prices up very high, then it makes sense to be the first one at the gate and say, okay, we produce flat out, and that's how this our trouble will start. I would predict. The other way in which it is connected is more indirectly, is that, of course, Trump has made it abundantly clear that he thinks low oil prices are a good thing, regardless what his own industry says to that. And producers play to that tune. And I'm sure that for the Kazakh government, they can now say that we are not holding prices up. We don't renege on our contracts. We and our American partners produce as much as we've promised to produce, and so on and so forth. And I think that probably also the Gulf producers will have told him when he's there, look, we are, not the bad guys here. We don't bring down the global economy. They won't have tell and believe that to you, but they will have said we will not do it. And that's the indirect ways in which it links to each other. None of that is sort of a conspiracy at all. All of that is reactions to the policies of the Trump administration.
Christof, it's hard to know because there's no obvious. I mean, you can't point to the UK trade agreement as some kind of success. There was some fudge deal of which there was little detail or substance. The China one is suspended. EU, there is no Exhibit A. This strategy is working, is there?
Not yet. I would agree with Dan in that at the end of the day, we will see at least some token tariffs. But I would agree with you that it will be more of a token than any. If Trump's whole history is one not only of making a big statement and then negotiating and coming out on the better side, is one of making a big announcement and then coming home with nothing and selling that as a great success. So if that is a model, then we will have some tariffs, but they will be moderate as long as the rest of the world sort of sticks together. And so far, you're right, it's only the UK who have caved into that. But the danger is elsewhere. The real danger of this is in the linkage of the external damage that does this whole tariff discussion and isolationism and what it does to demand and to growth, and the linkage to the fiscal deficit, which is emerging out of his big, beautiful tax bill. If that mobilizes, if that drives up interest rate, if that brings down bond prices, then there will be a real problem emanating from the center, from the financial center of the world, which is still the US. And that will be made worse by the tariff discussion, and that discussion will sort of have a ratchet effect on each other and spiral each other up. And that is a very horrifying picture if you look forward. And something, because it's financial markets, which will not be as easily fixable as tariffs, where you say, okay, sorry, I didn't mean it. Let's postpone it for 90 days. If bond prices indicate interest rates of 6-7% because of fear of inflation, you cannot dial that back. And if you look at this package, and if it's true that there are provisions inside which make it possible to punish external bondholders, for non-American bondholders, then nobody's going to buy that debt anymore. And that is much more consequential because it will ultimately lost to the position of financial leadership in the world, which I at least would have thought would never happen in my lifetime of the US. But that has the power to erode that kind of leadership.
Christof, just on that point, Christof, when we think about this bill and the stress it's bringing or could bring looking forward into the coming months as it comes to its sort of final wrapping up, where is there an intersection for the energy markets as we look forward? This greater fiscal fracture in the world's biggest oil-consuming nation, seemingly disregarding the signals from the bond markets, from the likes of Jamie Dimon, marching ahead. How should the oil markets be impacted? How should they prepare?
Well, the oil markets by themselves, without any of these economic warning signs, as I've been saying now for a long time, are at the verge of getting into a situation of peak oil demand or plateau. Don't think of it as a dramatic event, but demand slowing to the extent that the markets are no longer growing with all these consequences we have discussed many times. So it surely pays more than in the past to pay close attention to what happens on the global macro and growth side. And here are just 2 points I'd like to make. First, I think Dan is right. It's an expenditure problem. But if your own, and we don't know what happens and all the rest of it, but if your own congressional budget institution forecasts a deficit of higher than 9%, and you know that these forecasts are usually being trumped on the upside, not on the side of prudence, then it's really time to get worried. And the other thing is we have to be a bit cautious. One essential message of Jamie Dimon is not only this is going to hell in hell very fast, but it was, I just don't know whether it will be a tipping point or a breaking point of the system next month or in 6 years. And that's very, very true, because these kind of dynamics when it comes to bond prices depend a lot of expectations. And we still have also the Senate, which has to go and which may take out hopefully some of the worst provisions of this budget bill. So there is no cause for immediate alarm now and saying this is all done and dusted. But it certainly is a trajectory which, together with the tariff whipsaw, is not boding very well for the global economy. And what it will lead to is increasing fragmentation. And that, as Dan can explain to you, might be a good thing when globalization doesn't disappear and is replaced by regional alliances and all the rest of it. But in terms of global economic growth, it's a step back. And that is the bridge to energy markets. In terms of oil demand, then also it will be a step back.
When we look at the immediate outlook from the point of view of what might be identified, Christof, the war in Ukraine, we saw in the last few weeks, month in review, that it looks like the Trump-Putin love-in is kind of broken down. Is that your reading? How does the month ahead look for that crisis and other ramifications that you would identify looking forward?
This is a really difficult one to tell, because watching this now for too long, I cannot believe that Trump would seriously get antagonistic with Putin. It just doesn't seem to be in the cards for whatever miraculous reason. And there's got to be a reason somewhere, but we don't know about it. And I think that Russia or Putin itself is convinced that they long-term get the upper hand in Ukraine as long as they can neutralize the Americans, because Europe will not really decisively take action and take steps. And he might, unfortunately, be right on it. So I would see this continuing to drag on and not to stop until he doesn't get his 4 provinces, at least, plus Crimea, potentially more. The Germans have a new government. Polish and others are very still sort of alert of the threat of Russia. But you look
Big
at the
election
numbers
today in Poland, a big election today, where a presidential election runoff today, whether the hard right or the liberal left might win that election, just in Poland alone.
And it's still hard to see, for a simple-minded economist, when you take the number of people living in the European Union and their per capita income, including on military, how they cannot stop this in the Ukraine if they really want it. But they have shown so far that they're not really willing to take the pain it takes. And so I would expect this to continue. And then the other thing, you're closer to that in the Middle East, I think, is also at the mercy of Trump. And it seems to be also taco, so don't go too far, or stop here, don't go too far. And it doesn't really look like a coherent strategy, unfortunately.
If we might just conclude where we started, Christof, which is the OPEC Plus decision to continue to increase supply, which inevitably you would expect tomorrow morning when the oil markets open, although a lot of it was priced in, that will continue on a softer, bearish tone of the oil markets, the oil price and the outlook for the oil price in the second half of the year. What does immediate impact can that have on oil production? Dan mentioned all these wonderful companies operating in Kazakhstan, but putting money in the ground to build new capacity. Yes, the Gulf states may continue to do it, but where do you think the impact of this cycle will be across the US, the Americas, and elsewhere?
That, I think, is a really important point to understand. The immediate impact will be very minuscule. Because most of the oil projects are long-term, and think about Deepwater, that's one extreme. They will not certainly stop producing just because of temporary low prices. But also, very importantly, what people think that shale will go down and all of that, That is not correct because we know historically that in the oil business, cost follows prices. So every time we have a price cycle going down, the costs for steel, rig rates for labor, truck drivers, everything goes down, follows it with a lag. But onshore in the US, that lag is the shortest in the world because they have the best infrastructure in the world. So it's only a matter of maybe 15 months or so. And I tell you, just look at the balance sheets of big oil companies at their profit and loss accounts. They make the same rate of return ultimately at $200 oil as they make at $20 oil. And the secret to that is the adjustment on the cost side which take place. So this will be a painful adjustment, but in terms of production, it will be decided by those who can ultimately outperform the others the most, and that's the low-cost producers in the Gulf and elsewhere. But before it comes to crunch time, we will have to have prices fall dramatically more.